Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greater Office. We are glad that you can join us. So this morning we're going to find out what MRB have to say. They believe fundamentally that the Fed policy will not become restrictive. Bank credit analysts believe markets have not yet bottomed, but we are close to the bottom, provided monetary tightening eases. ECR believe a rally is also in the offing since a high global debt to GDP means central banks cannot risk a recession. However, they do think that inflation will remain elevated, so portfolios need to be positioned for that scenario. Edison also cite the the 226 trillion global debt pile. Investors should be ready for all kinds of outcomes. Let's start off then with MRB. They talk actually about the first quarter US earnings. So the US first quarter earnings season is almost at an end. There have been some notable high profile earnings misses, primarily in the consumer discretionary and the financial sectors. Target, I think, was one of them. What is notable is that profit margins are weakening. More companies are struggling with rising input costs. Margins, as a result, are edging lower and likely to over the next 2 or 3 quarters. Forward-looking, a greater percentage of companies are issuing negative guidance. Most companies that have lowered their guidance have cited supply chain issues or cost inflation. The warnings by companies that the macro environment has become more uncertain point to increased risks of negative earnings surprises in future quarters. However, it's not all doom and gloom. It's premature to worry about significant downside risks to earnings until the Federal Reserve pushes monetary conditions into restrictive territory, which is unlikely in the next 12 months. Aggregate household balance sheet is in better shape now than even before the pandemic recession. Households still have substantial savings accumulated over the pandemic from deferred services consumption as well as saved up fiscal transfers. Corporate balance sheets are still in good shape. Household, consumer, or corporate debt is not out of line. Much of the past 2 years' fiscal support, comprising transfers to households and businesses, has not yet been spent. Forward markets have currently priced in the end of the Fed's policy normalization at a terminal policy rate near 3% by the middle of next year. We estimate that the economy's neutral policy rate is nearer 3.5%. In other words, even at 3%, monetary policy will still be stimulative. And then history indicates that the odds are decisively in favor of positive price gains. That's price gains in equity markets on a 3, 6, or 12-month horizon from a bear market starting point. On a 12-month horizon, the S&P 500 has delivered a mean and a median gain of 16% and 18% respectively, when the index is down 20% or more from its 1-year peak. So the million-dollar question, have we hit that point yet? A catalyst is likely needed for a sustained equity market rebound. Less hawkish Federal Reserve rhetoric probably hinges on concrete evidence that inflationary pressures are abating. So we don't know for sure whether that was the bottom, but our best view, and we would mirror what MRB is saying here. The upshot is that although the S&P 500 is much closer to its low than its high, and return prospects have improved following the sell-off, the market is likely to remain volatile in the near term, and a better re-entry point may yet develop. The report that we've got now is a little bit more sanguine. It really chimes, I think, with the moderate view that we hold at Overberg Asset Management. The recent simultaneous drop in US Treasury yields and US share prices indicate that the market theme is shifting from inflation to a growth scare. The next phase of the sell-off in global risk assets will likely be characterized by heightened growth worries. This phase will also mark the final chapter of this bear market. And what is this premised on? Well, they've got 4 or 5 different factors that they've looked at. First of all, global trade volumes are heading into contraction. Second, US rail carload is contracting. Third, top-line growth and shrinking profit margins are likely to cause US and even emerging markets corporate profits to contract by about 5% and 10 to 15% respectively in the next 12 months. Neither US nor emerging market stocks have priced in negative profit growth. Fourth, slowing global broad money growth is typically associated with a compression in the price earnings multiples of global equities. And finally, sentiment towards US stocks is still very elevated relative to sentiment towards US treasuries. The Federal Reserve is not about to do a policy U-turn in the near term. Therefore, the Fed and stock markets remain on a collision course. What are the catalysts that are required to lead investors to buy more than they sell in the markets? First of all, inflation needs to decelerate faster than anticipated over the coming months, which in turn would cause the Federal Reserve to soften its hawkishness. And after that, there will be a Goldilocks environment of falling inflation and supply-side-led growth, which will buttress equities. Bank credit analysts expect global stocks to rise by 15 to 20%, even from current levels, over the next 12 months, with non-US markets outperforming the US. So, a little bit on ECR, they're basically saying that even though interest rates are rising and that there's going to be quantitative tightening, that monetary policy will not be restrictive once the Federal Reserve is done by the first quarter of next year. And they don't want to be restrictive. They're worried about another credit crunch because of the huge amount of global debt, due to the fact that total debt to GDP ratios have risen to excessively high levels in many countries. Most economies have become far more sensitive to higher interest rates. And ECR continues, as the consequences of a recession are very severe, central banks will probably prefer to err on the side of slowing down the economy too little rather than too much. As a result, inflation will stay above 2%, but this is a less bad outcome than a recession and a credit crunch. Shares are likely to start another rally phase. The Fed is likely to intervene if the S&P 500 index is somewhere between 3,500 and 3,700. This level is likely to be accompanied by lower oil prices and a further decline in inflation expectations. And I think Edison has got a very sober, mature outlook. They're not promising anything. They're sitting on the fence. I think the longer that any asset manager has had in terms of experience campaigning, the more that is the safe bet. So Edison, the main uncertainty is the duration of the surge in inflation and the timing of the inflection point in monetary policy tightening. And this is my favorite quote for the day. Portfolios should be prepared for a wider than normal range of economic outcomes. And that certainly is what Overberg Asset Management's global portfolios and local portfolios are positioned for. And then finally, very positive, also a report from the Financial Times. Corporate executives, the insiders, are buying shares in their companies at a rate not seen since the early days of the COVID pandemic, the strongest rate since March 2020. Strong insider buying has historically been a pretty good sign of market bottom. So on that cheerful note, Gielie, it's over to you.
Thank you very much for another comprehensive macro overview. On the JSE, Reinet Investments reported, we hold Reinet shares, that their share buyback program was completed on the 23rd of May, and they bought back a total of 810 million shares. The total value was 49 million euros. And the Reinet also, this is an interesting one, they also indicated that the total income rose for the year 2022 year to 353 million euros, and that is up from the previous year, which was 174 million euros. It's an increase of 102%. It's not bad. And they also said that their net asset value reflects compound growth of 9.7% per annum in euro terms since March 2009. It's really excellent results that. Then I think you've all heard that African Bank has purchased Grindrod Bank from Grindrod for a total cash consideration of 1.5 million rand. And then Investec, they announced that they hold 22% of 91 shares, going to allocate 15% of that holdings to the shareholders. So our Investec shareholders will receive some 91 shares. And if you're interested in Bitcoin, the price now is $31,000, up from $28,000 last week. And then statistical overviews. The PPI for April year on year was 13.1%. Now PPI is the prices at the factory gate. And that 13.1% is really, it's very high. It's because that is so high, it will be difficult to drive down the inflation rate because that PPI eventually becomes the inflation rate. I don't expect the inflation rate to go up to 13%, but it's heading in the wrong direction. Money supply for April was down 7.5%, and the private sector extension for April remained the same. It's 5.99%, make it 6%. And then yesterday we've all heard about the unemployment figures for Q1. It came down from 35.3% unemployed to 34.5% unemployed. Unemployed persons in South Africa now is 7.9 million. You can make it 8 million. And then the balance of trade for April, it came down from 47 billion rand to 15 billion rand. They expected 30 billion rand, but it came down to 15 billion rand. So that was a disappointment.